Good day everyone. So today I will discuss briefly one of the chapters of the strategic cost management, and that would be the financial and non-financial performance measures. So the reasons why I choose this topic is, first, it is timely. Especially with increasing global competition, it is important for a company to measure the performance from a financial and non-financial perspective. Second, it is relevant, since the company is using strategic performance measurement to motivate the managers to provide a high level of effort. Third, goal-driven. Management compensation frequently includes incentives tied to performance. The objective is to encourage goal congruence. And fourth, measures the performance. The advantages of using performance measures that are directly affected by a manager's efforts encourage the use of non-financial measures. So next would be the concept of this topic. The strategic performance measurement or evaluation is the main emphasis of the management control system. Performance measures are an important part of management control systems, and they must drive managers and employees at all levels of the company to strive towards the organizational goals in order to be effective. Financial or non-financial data can be used in a management control system. Return on investment and residual income are two financial indicators that can capture essential features of both managers and organization subunit performance. In addition to that, the most commonly used instrument is the balanced scorecard. Different organizations, though, may use and emphasize on elements on their scorecards. Most scorecards include, first, profitability measures. Second, customer satisfaction measures. Third, internal measures of efficiency, quality, and time. Then fourth, innovation measures. Also, in designing accounting-based performance measures, the following steps may be followed. First, choose performance measures that align with top management's financial goals. Second, determine the time horizon of each performance measure. Third, define the components of each performance measure. Then fourth, decide on a target level of performance. These are the following key terms about this topic. First, performance evaluation. The process by which managers at all levels gain information about the performance of tasks within the firm and judge that performance against pre-established criteria as set out in budgets, plans, and goals. Second, net book value maintains consistency with a statement of financial position prepared for external reporting purposes. Third, gross book value or the acquisition cost. It eliminates the misleading increase in ROI and residual income across time. Fourth, timely reporting. Timely reporting of actual results and identification of the causes of the deviation could signal that correction action should be taken so that the plan can be executed as intended. Fifth, multinationals. These are the companies that operate in several countries. And sixth, economic variables. It includes currency restrictions, taxes, transfer prices, capital markets, and inflation. And this part, I will show you an illustrative problem. Consider the following data for two geographic divisions of Mindanao Electric Company that operates a profit centers. So the Eastern Mindanao Division and the Western Mindanao Division. Total assets for Eastern Mindanao is 2,500,000, while 6,250,000 for Western. Current liabilities, 750,000 for Eastern Mindanao Division and 2 million for Western Mindanao Division. Operating income for Eastern Mindanao is 500,000, while 1 million for Western Mindanao. So required. First, calculate the return on investment for each division using the operating income as the measure of income and using total assets as the measure of investment. Then, Mindanao Electric has used RI as the measure of management performance, the variable it wants a manager to maximize. Using this criterion, what is the RI for each division using the operating income and total assets? If the required rate of return on investment is 12%. And for the second requirement, we will calculate the economic value added. But first, we will answer the first required. So we will calculate here the return on investment and the residual income. So first, we will calculate for the Eastern Mindanao Division. So total assets is the 2,500,000, operating income 500,000. So for ROI, 500,000 divided by 2,500,000, it is equal to 20%. For Western Mindanao Division, 6,250,000 for the total assets and the operating income is 1 million. So 1 million divided by 6,250,000 equals 16%. Then the residual income at 12% required rate of return. For Eastern Mindanao Division, it is 2,500,000 multiplied to 12.12 or the 12% required rate of return, it is equal to 300,000. For Western Mindanao Division, 6,250,000 times 12%, it is equal to 750,000. And now we will answer the required number 2. So after tax cost of debt financing, that would be 6%. After tax cost of equity financing, which is 14%. First, we will calculate the weighted average cost of capital. So 4,500,000 multiplied to 6% plus 4,500,000 multiplied to 14%. Then divided by 4,500,000 plus 4,500,000. So this 4,500,000 is the equity and the debt finance. So 750,000 plus 630,000 divided by 9 million. So 900,000 divided by 9 million, that equals to 10%. Now we will calculate the economic value added. For Eastern Mindanao Division, after tax operating income. For Eastern, 5,000 multiplied to 60%, which is 300,000. Western, 1 million times 6%, 60% rather, that is 600,000. Then, less cost of capital for Eastern, it is 175,000. For Western, it is 450,000. Then, we will deduct this 170,000 to the 300,000. That equals to 125,000 for Eastern Mindanao, while for Western Mindanao, 600,000 less 450,000, and that equals to 150,000. And that would be all. Thank you. And this is Maria Stephanie Jules Ibanez Corayag reporting.